right, one of the things that I want to discuss as far as this class is concerned are some of the long term liability issues like bonds and leases. We're not going to go into a lot of detail on these, but I do want you to just have an overview about what some of the things are that are entailed with these. With bonds, these are interest-bearing notes. They are generally issued by corporations. They can be issued by governments or as well as universities. They usually are in $1,000 increments. So you could have a bond for $1,000, maybe a bond for $5,000, a bond for $20,000, or how some of these bonds actually can be issued. What generally happens when we look at these bonds as far as the different types go, we do have the secured bonds. A secured bond, just like a secured note, is actually going to have collateral up for it. So if a bond is secured by real estate, it's called a mortgage bond. And then what will happen is if a bond is secured by certain other assets, it could be a sinking fund bond, but they are actually secured by some form of assets. An unsecured bond is also known as a debenture bond. These are issued against the general credit of the borrower. So just like if you went out and got an unsecured loan, the interest on that actually is a little bit higher if you were to do that because they are pretty much just giving it to you based on who you are. There's no collateral for that particular bond. Other types of things we need to look at are the convertible bonds. A convertible bond is a bond that can be converted into stocks. And there are people out there that like these bonds. They pay interest up front, and then they can be converted into stock later if you would like for it to be. And then the last one is a callable bond. A callable bond is a bond that, though it has a certain maturity date of, let's say, 20 years from now, it can be called in any time. So if the company decides that they are ready to take that bond back in, they can call that bond in and actually pay the principal or the face value on that particular bond. All bonds have a face value. This is going to be the value that you receive at the maturity date. They also have contractual interest rates, which is also known as stated rates. And then they have the maturity date would be listed on them. You would have a bond certificate, and the bond certificate would have all of this information on it. Now, in figuring market prices for bonds, this is one of the mathematical things that you will have to do for this particular chapter, is going in and looking at what the market price is going to be. Now, the way that a company would figure out what the market price is they would actually use present value tables. Now, I'm not going to require you to use the present value table, but they can be figured in these ways. And what we see is that bonds can be issued at their face value, they can be issued with a discount, or they can be issued at a premium. Now, when they're issued at face value, what this is saying is that the interest rate that is on my bond is pretty much equal to the interest rate that is out there in the market currently. And so those are equal, and so we have everything kind of set up the way we need it to be, and so it's going to be sold at its face value. Now, when bonds are issued at a discount, what this is saying is that, my bond maybe is paying 5% face value, and the bonds that are currently being issued today are paying a 7%. And so nobody really wants to pay the full amount for my bond because they're not going to get as much. And so what I have to do is I have to discount my bond to make it equal to the present value of what that 7% bond would actually be paying. And so that's what I would do is I would look at doing the discount and find out, what I need to charge for my bond. And I do have to discount it down because they don't want a bond that's paying 5% interest. They want a bond that's paying 7% interest, and so they're not willing to pay the full price for my bond, so I do have to issue it at a discount. When we look at premiums, this is where we would say, okay, our bond is paying 10%, and that's the face value of our bond, and those bonds out in the market are only paying 7%. So everybody wants our bond. And with the law of supply and demand, if everybody wants it, then I don't have enough, so the price will go up because I don't have enough of a supply of it. Because everybody wants that higher interest rate to be paid to them. So in this case, we would actually have a premium, and we would charge more for our bond because our face value is higher than our stated interest rate is higher than what somebody could get out in the marketplace. So what do the journal entries look like? Well, when we issue a bond at face value, let's say XYZ issues 1,000 $5,000 bonds. So the first thing we need to look at is see how much money are they going to have coming in. Because if they issue 1,000 $5,000 bonds, then they are actually going to be getting in $5 million. And so when we look at this particular journal entry, what we will have is we have cash coming in at that $5 million, and we owe this money. It's a liability, and that liability is called bond payable, or bonds, I guess, payable for the $5 million. Now that's if we issue at face value. It's very simple. Cash comes in, we have that liability. When we issue it at a premium or a discount, there's a little bit of different things that we have to do. The first thing we have to do is we have to figure out what are we receiving for the bond. So if it's issued at a premium, an example is XYZ issues $100,000 worth of bonds at 102. Now what that 102 means is it means at 102% of the face value. So what we would do is we would take 100,000, we would multiply it by that 102%, which translates into 1.02, and that means that we are going to actually issue these bonds out at $102,000. So the cash that we are going to be receiving is going to be $102,000. But the bond payable amount, the amount that we have to pay at maturity, is actually only $100,000. So if you notice, our debits and credits are not in balance, so we have to make sure that we balance those out. So we have the cash, we have the bond payable, and the account we're going to use here when we issue it at a premium, we would have premium on that bond payable at the difference, which is $2,000. So that's how we would issue it at a premium. Now, if we had it at discount, we would do pretty much the same thing. So see, XYZ issues $100,000 worth of bonds at 95. 95 means at 95% of the face value. So we would take the $100,000, we would multiply that by that 95%, and we would get $95,000. So in this case, we are only getting cash in of $95,000. But when that bond matures, we have to pay the full face value of that bond, which is $100,000. Debits and credits don't equal. We do have to have an account for this discount on bond payable, and that is going to be for the difference, which is that $5,000. So now when we get through, we do have this journal entry where everything is in balance. Now, if bonds are issued at a premium or a discount, they have to be amortized over the life of the loan. This is going to affect their interest expense for the period, because what we ultimately have to have is by the time that this particular discount is finished, we need, or by the time the maturity hits, we need this discount to be at $0. On the premium side, we need the premium to be at $0. So we are going to have to amortize it over the life of the bond. And we do use straight line amortization. So with straight line amortization, we would take the amount of the premium and divide it by the number of periods that we would actually be paying interest out on one of these bonds. And we would amortize it each month. If we have a discount, then we would actually have a lower interest expense. If we have a premium, then we would have a higher interest expense each period than that stated rate of interest. So we're not going to work these. The appendix to your book actually has it in there. You can look at it. This would be covered in a more advanced accounting class on how you do that. The other thing to look at for this chapter is leases. And you might ask, why would a lease be in the long-term liability section? Well, that is because there are two different types of leases. We have an operating lease and we have a capital lease. With an operating lease, this is the intent is temporary use of the property. The lessor actually continues to own the property. When we see this, this is going to be a rent expense item. All right, so we're temporarily using something, that would be an operating lease. The second lease that we have is a capital lease. Now, in order to have a capital lease, we have to meet a couple of things. The first one is that the lease will transfer the ownership of the property. We have to have a bargain purchase option. Now, a bargain purchase option is if at the end of the lease you can purchase it for $1, that would be a bargain purchase option because it's probably worth more than $1. So if you're actually able to purchase it for less than its market value at the end of the lease, and what I see a lot of time with these is it would be valued at, they'll say, oh, you can pay $1 or you can pay $100 at the end of the lease period, and it belongs to you then. It's no longer a lease. That would be a bargain purchase option. If the term is equal to 75% of the economic life, what this is saying is if the economic life of this product is at, let's just say, 4 years, and your lease period is at 3 years, well, that's 75% of the economic life, and so it would be considered a capital lease. And the other thing to look at is the present value of the lease payments. If they equal or exceed 90% of the fair value of this lease, it is considered to be a capital lease. And capital leases are treated a little bit differently in that they will show up on the balance sheet. And so the journal entry that we would make when we actually had one of these capital leases is we would have the leased asset would be added to our balance sheet as an asset, and we would have our lease liability on there as a liability. And so these would affect the balance sheet, where a regular operating a lease only affects that income statement as far as that rent expense is concerned. Now, the portion of the lease liability that's expected to be paid in the next year would go on the current section, not the long-term section, as if we're looking at a classified balance sheet. So that's something else that I want you to remember. So just make sure you realize that as far as a lease is concerned, it could be an operating lease that just has a rent expense attached to it, or it could be a capital lease in which we have to record it and actually place the asset in our books as well as the liability in our books. And so that's pretty much all that I wanted to talk about as far as this class is concerned with those long-term liabilities. So just make sure you review some of these entries and understand some of the concepts that we've discussed in this particular chapter.